So we're going to get less silver coming from silver mines, despite structural deficits in silver, despite the fact that we can't produce enough silver for the annual demand. So the market is just a perfect setup for an eventual squeeze in terms of silver and that for the silver price to just explode higher at some point. So the first thing is that I think that silver is, if you look at where it was a little over a year ago, still silver's doing quite well. To the best of my memory, in say February of 2024, it was bottoming around $22 and then made a strong rally within a few months, 6, 7 months to believe it was $35 in October. And then it backed off, kind of went sideways in, I would say, the 28 to 30 range for a little while. And then we had a run up again recently. And if you look at silver futures prices, it actually hit the target I was saying earlier this year that in the first half we would reach $35. And we did reach $35, at least temporarily, a few weeks back in silver futures prices. Now, I think that, first of all, even at $30 or $31, that's very strong compared to $22, February of last year. So silver's looking quite good. The miners are, I think, happier because obviously that there have been increases in costs, but they certainly are earning better margins at this point. And I think that we could see considerably higher silver prices in the second half of this year. A few things I think will be driving that. But if we come back again for a moment or two, we saw silver, as I say, run up to $34, $35 recently, and it backed off. It certainly backed off with these big tariff announcements. I think that silver was. It's interesting that silver actually backed off before the announcements, a few weeks before, um, despite gold not backing off. So certainly they've acted differently. Silver has taken, in recent weeks at least, has taken on more of its role, I think, of an industrial metal, which is about 60% of its consumption these days. Um,
How
but I
much?
think
Sorry,
it may
60.
60, yes. And I think it has, we can talk about that, how that has shifted if you want afterwards, but I think it correcting before gold is almost as though it was sniffing out that we were going to have a higher risk of recession at some point. And it's almost as though it was saying something's coming that will slow down the economy significantly. And because of that, there's a risk that the consumption of silver will fall off, again, it being more of an industrial metal. And to that extent, I think it was sort of foretelling what has happened in the last couple of weeks. Now, I also think that to some extent, a backing off because of concerns of decreased consumption due to a slower economy is warranted. I also think that it's probably overblown by the market. We can talk about details relating to that as well, but I think that overall, after a couple of quarters, perhaps the market will see that the consumption of silver really has stayed very robust for several reasons, and I think that is what points to considerably higher silver prices in the second half of this year. So there are a lot of implications. So just for your viewers to maybe understand a little bit of what has been going on in the silver market, not only in silver, to be fair, gold, copper and other merchandise, other goods and so on. So since Trump was elected back in November, until recently, there had been some talk of, him imposing tariffs. And obviously, the tariff talk got a lot more concrete once he was inaugurated and took over as president in late January. But despite that, the market saw the risk of tariffs being imposed on all kinds of goods that would be imported into the US. So his thinking is that we tariff manufactured goods being imported into the US that makes them more expensive, and it stimulates consumption at home and production at home in the US. But that risk of tariffs on silver, for example, is like I say, as well as gold and other things, other metals and whatever, got participants in the US concerned that if they had to make deliveries of these metals that they already didn't have control of and that were already in the US, they would have to import them after tariffs were being applied. And of course, they would have to pay that say 25% tariff or so on the value of the amount that they had to deliver to a domestic client. And so we've seen huge flows of silver come out of London, where we have the largest inventories, and flow west to New York. Now, interestingly, a lot of this is, I'm going to say, to some extent anecdotal because there isn't perfect transparency on a lot of this data. But what we do know is that not only was there a lot of silver, like outsized amounts of silver were flowing from London to New York, but when it got to New York, we've had huge deliveries. And you pointed to that. You're absolutely right. March had the second highest delivery from COMEX ever. It's worth pointing out, too, that COMEX was not built or designed for taking physical delivery. It's a futures market, and it was built to trade futures contracts and to use those to hedge prices. So for manufacturers or whomever, deals with large amounts of silver, and we're going to talk specifically about silver. It's the same for all the commodities, but to be able to hedge risks that they may have of silver prices moving up or down. So to see huge amounts of delivery of physical silver out of the COMEX is very telling. I think that what it does is it speaks to extreme tightness in the silver market. There is nowhere near as much physical supply available as I think a lot of participants or observers believe. And this, I think, is proof. On top of it, I mean, it's true that we're looking back because these are March numbers. We just got these tariffs that have, by the way, Trump has backed off on the majority of them for at least 3 months now. We know that as well. There was already
Except
rumors
China.
of that, right? There were already rumors of that, I think, the next day after markets were crushed. But all that to say that this data is looking back. So I think that it's clear that participants were very concerned and took the physical delivery in case they had to themselves deliver to clients to eliminate the risk, right, of not having the silver and that of the silver having to have these tariffs applied to them. So that's very telling. But something also anecdotal about deliveries into New York is that I've heard that not only what has there been a lot of silver flowing from London to New York, but also that the we've had higher than normal deliveries, as we've just heard, out from the COMEX to take for participants to take physical delivery, and it would stay in the New York area, and it would stay in private vaults. So the point being really that participants want to have their physical silver. They are not comfortable with, for example, for whatever their reasoning, to hold a futures contract that is basically a promise or an option to take physical delivery.
Exactly.
And there are premiums, what we call exchange for physical premiums. So in other words, a premium between the physical price or the spot price and the futures price. And these exchange for physical premiums have been way higher than normal over the last several months. So again, that speaks to participants really wanting to hold the physical silver and eliminate the risk. Well, that's interesting too, because if you look at the data that we have, mostly comes from the Silver Institute, and if you look back at the last, say, 4 years, 5 years, it's very interesting that just again for your viewers to get a quick overview, the silver market is about 1 billion ounces a year of supply. About 85% of that comes from mining, so newly mined silver, and then another 15% comes from recycled silver. So altogether, we have about a billion ounces available every year of supply, of new supply.
Mhm.
Um, and however, demand is 20% higher than that on average for the last 5 years. So 1.2 billion ounces. So the silver market has been short about 200 million ounces every year for the last 5 years. And the projections are that for this year, it's going to be somewhere around 145, 150 million ounces again. So if you add together the last, let's say, including this year, these last 5 years, you're at you're at about a full year's supply of silver that we've been short for the last 5 years. So it's tremendous. And the question always comes back, well, if the silver market is so tight, how come we haven't seen the silver price just go through the roof? I mean, there's always obviously lots of talk of manipulation and pressure from outsized quantities of short futures contracts and so on. If we put that aside for a moment, if you look at what has happened in the last, say, 4 years with the inventories in two places. One is the futures exchanges, the main large futures exchanges, the New York COMEX, the LBMA in London, the Shanghai in China, and then also the silver ETFs. So that has reversed in the last couple of months. But if you look over the last, say, 4 years, it's been very revealing how the inventories in these markets have consistently been drawn down. So last year, I started to look into this because I too was wondering, how is it possible that, we've got these structural deficits every year, 3, 4, 5 years in a row, but yet the silver price appears to be capped. And the conclusion I came to was that these big consumers of silver, I'm going to say mostly industrial, because a lot of the rest, say investment type consumption is more optional. You can, if the price is high, you can perhaps not buy, etc. But the industrial consumers really have essentially no choice unless the demand for them drops off for some reason. But so that's a pretty consistent demand from the industry side. And so I realized that because there are these relatively large what I call secondary inventories, above ground accumulated inventories of silver, they have been able to go to these stockpiles and buy as they need and draw them down. And this has, if you think about it, that means they can buy silver at prevailing prices and not pressure supply because there is this, as I say, this above ground existing supply that they can draw down. So I believe that is what has been going on since early 2021. But those supplies have drawn down, depending on which market, anywhere from about 40 or 50% down, about 70%. And if you look at, and this was even exacerbated tremendously over the last 3 months when, there was this concern with tariffs. And it's true that supplies from London to New York is not a net drawdown in supplies. It's actually a shifting of where the inventories are, right? They're not necessarily being consumed, they're just being moved around. So they're coming from London and they're going to New York. But the fact that New York has seen massively outsized deliveries to me is very telling as to, again, the tightness in the market. And, as I say, the last 5 years, if you include this year with the forecast for this year,
Mhm.
large supply deficits. And you look at, for example, I think it's S&P Global Intelligence. About a year ago, they were looking at mine supply, and they were saying their forecast is that silver from primary silver miners. So again, there's a lot of information to add, but about 75% of mined silver does not come from silver mines.
Yeah.
It comes from, as a byproduct of mining other metals, from gold mines, from copper mines, lead and zinc mines, that kind of thing. So only about 25% of mined silver actually comes from silver mines, true or primarily silver mines. So S&P says that even over the next 2 to 3 years, we're going to see silver from primary silver mines actually continue to drop off. So we're going to get less silver coming from silver mines, despite structural deficits in silver, despite the fact that we can't produce enough silver for the annual demand. So the market is just a perfect setup for an eventual squeeze in terms of silver and that for the silver price to just explode higher at some point.